Hey, everybody. Today, we are going to find out why you should be forgetting all about Texas and the Carolinas and all those places where everybody wants to invest and instead focus on the hidden gem of the Midwest of the United States. And today I have with me Logan Freeman, who is all in on the Midwest. And I, for one, as a Midwesterner, nobody knows this, but I'm actually from the Midwest myself originally. I'm all ears. I want to find out all about it. So Logan, welcome to the show.
Well, thanks, Jonathan, for having me. I'm just really excited to be here and share some insights and some experiences with your listeners.
Well, first off, so tell me like the snapshot of what your company looks like right now.
Yeah, so we've got about 30 employees, and that spans property management on the commercial and multifamily side. We have obviously in operations, we have construction management, we have asset management, finance and accounting, investor relations, marketing, and then acquisitions. And so, what I've tried to create is a kind of an ecosystem where I can control most of the choke points that I think operators typically find themselves challenged with in real estate. And I've worked with a lot of third-party vendors, and at the end of the day, your investors don't care if it was a property management mess up or it was their fault. They're looking to you as the sponsor to fix problems and or mitigate risk. And so the best way that we have been able to do that effectively and control those choke points a little bit better, because you can't control everything, but actually positively affect change, is by being a true operator. So going out, finding deals, managing construction, leasing up properties, and then owning a brokerage as well. I have 5 brokers here at the company, and being able to go dispose of those and also know where the markets are at and when the best time to sell is. I think people don't talk about asset management very much. Asset management being like, hey, this is, I'm going to manage the property manager. Okay, but who's doing wholesale refinances on a quarterly basis? I mean, look at the capital markets right now. You could have went live with a deal 3 months ago, and you're trying to close a deal right now, and you're having a big snapback effect. And John T. Chang at Marcus & Millichap kind of coined that term last year. Well, we're feeling it again right now. And so at the end of the day, I think that asset management is extremely important and an often overlooked facilitation of real estate deals, not just from managing the business plans, but also understanding when is the best time to dispose of an asset and how do we actually get to that finding. So that's kind of the snapshot of the company. We're in multifamily, office, neighborhood retail, shopping centers, industrial, and hotels. So I would say our biggest focus right now is in triple net lease, industrial, and retail. Believe it or not, we're finding a lot of success with these neighborhood retail, e-commerce resistant, service-based properties that are really doing well and holding up really well against the Amazon effect. And we've got 2.5, 3 years of data to kind of see how they have performed. So, and we're primarily, like you mentioned, focused on the Midwest. So Missouri, Kansas, Nebraska, Iowa, Oklahoma, Arkansas, Ohio. We'll go up to Michigan and Minnesota every once in a while to look at some stuff, but love the Midwest for a lot of reasons, and I'm sure we're going to touch on those.
Absolutely. And you're based in Kansas City.
We are, yeah.
Okay. And so obviously you don't build all of this overnight. I mean, how long have you been in this business? I mean, looking at you, you look like a pretty young guy, certainly a lot younger than me. So when did you get started in this?
About 9 years ago, I was cut from the NFL, and that was kind of a big turning point in my life. I didn't really play in the NFL. I made it through some cuts, whatever. I got cut. I decided to go back to school, finish my master's degree, but had no money. I'm a Midwestern boy from Jefferson City. My mom worked 2 jobs, lost my dad to drugs and alcohol 9 years ago as well. So really came from, and he had 13 brothers and sisters on a 1-bedroom house at a tobacco farm in North Carolina. So do not come from, business, entrepreneurship, anything, but did have a massive drive and internal fire to say, look, I want to get out of and break out of, this type of life and provide a legacy for my children. I have 2 young kids right now as well. But so 9 years ago, kind of went back to school, finished my master's degree, and then started, I'll say this too. when you get cut from the NFL and you're an undrafted free agent, you didn't make any money. And so I had no scholarship. So I would drive an hour to Sweet Springs, Missouri and make 265 cold calls a day. And then I would drive back an hour to Warrensburg and go to school all night. And you know what that taught me, and being an offensive lineman in the NFL Combine, I was 335 pounds. But I went through a big physical transformation. I definitely don't weigh that anymore. But in 6 months, I lost 120 pounds. And but the bigger transformation was in my mind, and that was listening to Tony Robbins and Jim Rohn and Zig Ziglar and Robert Kiyosaki, and podcasts were just getting going 9 to 10 years ago. So it was, you know, Lewis Howes and John Lee Dumas and all these, you know, OGs on the podcast circuits. And that really transformed my mind, because I was listening to what true entrepreneurs and businessmen and women were doing. And then I was going to school, learning about regression analysis and statistics and chart of accounts and accounting. And I'm sitting there with kind of cognitive dissonance saying, you know, what is actual business? Because I don't think it's what we're talking about here in these classes. And long story short, man, I learned more after getting out of school through books, 750 to 800 books that I've read, that really started to form my kind of thesis about life and business and entrepreneurship. And so when I got done with Sweet Springs, Missouri, making those cold calls, and I graduated, that's when I unfortunately lost my father. So I had another big kind of moment in my life. And, you know, I think this is where mentors have really played a huge role in my life, to kind of take the theoretical ideas that I was learning about in books and then see them being applied at an effective level out there in the real world, and saying, hey, man, you've got some choices here, and you can make a few choices, and your decisions are going to impact your outcomes. And so I had some big mentors that really pulled me up and really helped me get on the path that I am on today, which I'm always going to be grateful for. And so I started as the youngest franchise consultant that Jimmy John's actually had ever hired. So I had 25 stores between Missouri, Kansas, and Iowa. And I was basically, you know, a young gunner in there trying to hold them to high standards. And I think that's why that company has been so successful and been able to scale the right way. I mean, you go to a Jimmy John's, their bathrooms are clean. I don't know if their subs are as freaky fast as they used to be because of, you know, all the people that it's hard to get to work. But at the end of the day, I learned a lot about business from those guys as well. But I hit a glass ceiling really early. And so I left and went to a startup company with 2 people, hitting the phones again, 200 cold calls a day, helped grow that company. They're doing really well now. I was there for 2.5 years, left and went to a larger company that I thought was going to be safe. And 15 months in, private equity company comes in and lets the whole sales team go. So I was fired. And at that moment, my wife and I were recently married, and she had just started a new job. And she's like, look, I'm going to support you with whatever you decide to do. And so I knew real estate was one of the things that I wanted to focus on. And so coincidentally, I started as the head of acquisitions for a $50 million fund here in Kansas City. I was pretty successful with that fund. First year, got 130 transactions done. They were doing single family homes at scale. They were the 6th group in the country to go through a CoreVest portfolio refinance around their whole portfolio of 265 homes. So I got to have firsthand experience of what a syndication really was from experienced sponsors just working as a vendor. And I said, man, I love that model. I want to go build that, but on the multifamily and commercial side. And so I left and started doing brokerage in those asset classes, multifamily, triple net lease, commercial. And found a pretty good niche to work with buyers so I could continue to learn the acquisition process. And then I bought some deals myself, and I quickly ran out of knowledge, experience, and time and capital. Sat back down with those mentors, and they said, you need partners. If you want to scale to the level that you want to get to, you need partners. So that took another 2 years, and I went back out and found some partners, and that's what is now FTW Investments. And we kind of formally started in 2019, buying small multifamily, doing larger multifamily, and now we've got about 500,000 square feet on the commercial side as well. So that's kind of my background and my trajectory into the business. I know I dropped a lot of information on you there.
That was a lot, but it's an interesting story. I want to know, I mean, so, gosh, I can tell just from talking to you that you're very driven. I mean, you said you're very driven, but it's clear from the way that you talk, like so passionately about this, that you are a very driven person. Where do you think that drive comes from? What do you attribute
Yeah.
that to?
Well, I've always looked internal for not motivation, but inspiration. And I love the etymology of words. So inspiration is in spirit. I'm a very faithful guy. I'm a Catholic guy. So that's a big driver in my life. And so that's where my first motivation comes from, is to live as the best version of myself so I can, live with eternity in heaven, hopefully. And at the end of the day, that's my number one motivation. Then you get married and you're like, oh, okay, well, now I'm not just living for myself. Then you have children. And that motivates me as well. But I'm still trying to kind of go back in my early on, even, when my dad was around, and understanding where that true fire and motivation comes from. And I do think it's from, throwing hay in hay fields when I was 14 years old, and washing dishes at a catering business, and watching my mom work 2 jobs, me working 2 jobs, and just trying to understand how to break out of mediocrity and really create a life of success. And so that I can then work on initiatives that do help other people live as the best versions of themselves as well. So, but if I, go back to strength finders, discipline, motivation, individualization and competition are kind of my top 4 or 5 talents. And so ingrained in me are those things. But I do think my mom had a huge impact on me growing up, watching her work so hard to try to provide for her family. And I just wanted to make sure that, my kids maybe didn't have to necessarily always be wondering, where am I going to get my next pair of tennis shoes at? It's the rummage sale down the street, things like that. It was like, man, I think that other people are not worried about that. And I would like for my family not to as well. And that's part of it, I think, too.
And I'm not sure how to phrase this question exactly, but so there's inspiration is great, right? But you got to focus it somewhere, right?
Yeah.
And you talked about partnering, and I think these two things are related, because you can be really inspired and kind of really driven, but nobody can be driven at everything, and you can't be driven at all in all different directions at once. And like a successful business requires a bunch of different skill sets, right? So what do you focus on in your business, and how did you find partners to fit the other pieces?
Well, I think it's all about a counterbalance, right? And people always talk about work-life balance. And Gary Keller, in his book, The One Thing, really breaks this myth down of balance. I mean, think about somebody on a tightrope that is walking across a tightrope. They're always going back and forth. They're balancing that. They're counterbalancing. So I think that that's important to know and be understanding of. Different focuses in your life are in different areas. And so some may need more attention. For example, I got really unhealthy the last 2 years, and I've been focused on that for 18 months now, and I've lost 50 pounds again. I don't want to get back to that, football playing level, because I'm not playing football. So that's the first thing I think, is really focus on counterbalancing. That translates also into finding partners. And so I took a real hard look at self-assessing what my strengths were through Strength Finders, the Colby assessment, the Culture Index, and said, what do I need to supplement this strengths and these strengths that I have and the skill set that I have to be successful? You have to be aligned on vision and values, I think, regardless. And I think that's really important. But tangible skills, everybody has different IQ, everybody has different skill set and experiences. And so understanding that, I'm not necessarily a person that's focused on finance and accounting, or how to, lease up a property, or, construction management. So I needed to go find individuals who had those different skill sets really early on. So I basically brought a model of, it's called the Ikigai model from the Japanese, and it means meaning for life. It's just a Venn diagram that will help you understand what your sweet spot is, which is kind of the intersection of your greatest strength and your greatest passion. And so that is where you need to be focused on. And then I overlaid that mental model with all of the things that it would take to be a successful, operator in real estate, and say, here's where I'm weak at. I need you, potential business partner, to go take these tests so we can see where your tangible skill sets lie. And if we align on a vision and values, great. But if we're not aligned on the skill sets, then, we're not going to be a good pairing. And so that took a lot of time. I mean, it took 18 to 24 months to find folks that, were aligned on the vision and values, but then also had those skill sets. So it was networking my tail off in Kansas City to find those individuals.
And what's the thing that you're focused on? What would you say like in your division of labor within your business, what's your role?
Yeah, so taking a macroeconomic thesis, breaking it down to the micro, and then absolutely being able to communicate that to individuals that here's what we're focused on, here's how we do it, here's how we think about the world, and here's what we think is a good way to think about real estate investing. So that's the first one. I'm a brand advocate, right? So I'm kind of the face of FTW out there connecting with potential investors or partners. That also skill set really lends well to providing a lot of value to property owners and making them feel comfortable about how to think about selling their assets. What do you do when you sell? And so being able to be ingrained with property owners and say, look, I'm an owner too, so I understand a lot of the different things that you're and challenges you're going through. Here's how I think about them. So really it's on the sales, it's on the marketing side, it's on relationship side. So I call it manufacturing opportunity out of thin air. And so I need to be able to take what we're trying to focus on and then go find individuals and people and companies that fit into that mold. And so that's kind of my job, is to bring opportunities into our business and then advocate what we're trying to go accomplish. For example, we did a really great job with multifamily during 2020, 2021, while prices were going down and debt was going down. Guess what? It was really difficult to do multifamily the last 2 years. And so I had to then pivot all of our investors to think about the real estate investing landscape differently, to say there are other asset classes that may be performing really well right now that capital markets are kind of just glazing over and not looking at. And so now is the time to acquire different types of assets. So things like that sound really easy to do on paper, but then actually making that change and communicating that in an effective way is very difficult, and it takes a lot of time and effort. So that's kind of my job here at FTW, is really focused on that.
And so that's kind of a good, segue into bringing up, what you mentioned early on about liking this triple net industrial and retail space. So I want to hear about that. Tell me why you've kind of discovered those spaces, what led you to them, and why you think that they're an interesting play right now.
Yeah, I mean, I'll first say that I had experience in those asset classes from the brokerage side, so that's a first reason why. Secondly, you think about the four main food groups. You've got office, and anybody doing office right now, kudos to you. Hey, I'm going to let you be the first mover advantage. I think there's some cool plays in that space, but my operational advantage is not geared towards office. The only reason we own an office building is because we needed space, and I redeveloped it to get it leased up before we close. So long story short, not really focused on office. Okay, so then you go to retail. Well, the riches are in the niches, and retail gets a bad name because you see these big box retailers maybe going out of business. But I always have investor meetings in neighborhood retail shopping centers for a very specific reason. We walk out and they're like, yeah, I'm not sure I'm still sold on triple net lease and retail. And I say, turn around, look at the coffee shop we just walked out of, look at the chiropractor that's down the street, look at the dental office that's in the shopping center, look at the grocery store, all of those things. And people start to really say, oh my gosh. So there are businesses and people that need places to work in well-located shopping centers that allow folks to have good traffic counts. And it's a very niche asset class. There's not that many of them in Kansas City that I could go acquire. So they're smaller deals and they're harder to find, and there's not as many as that they could go execute on. So it's like, yeah, I'm not going to do that. So I love that when somebody says, that's too hard, I'm not going to figure that out. I'd like to step in and figure that out. So that's on the retail side. On the industrial side, I just think that the onshoring of manufacturing and the deglobalization effect is going to be hugely impactful for the United States over the next 3 to 5 years. And what does that mean? Well, I think that flex industrial is positioned to perform extremely well. So if you take a 200,000 square foot industrial building, you have 4 or 5 tenants in that building. They have their office in the front half of that space, and then their warehouse in the back half of that space. Those are the types of spaces that are in high demand, at least here in the Midwest and in Kansas City. Maybe not necessarily the 300 to 500,000 square foot single tenant deals that have been developed. I think that the supply there may be where it needs to be, in certain markets. But the demand for smaller spaces in buildings that were already existing, that rental rates don't have to be $15-16 triple net lease for these types of centers, I think is highly in demand. And we've had a lot of success looking at those. Again, smaller asset classes or asset sizes and not as many. So, they get overlooked. So that's that side. Multifamily, I have done everything from Class D to Class B. And I will tell you that implementing the business plans on Class B assets that have a renter pool that can withstand some drawbacks and or adopt technology a little bit easier and have less CapEx issues is where our focus is on the multifamily side. Still extremely bullish on multifamily, but I think that what is lost in pro formas a lot of the time is the risk that it takes to take a Class C to a Class B building and the time that it takes to really do that, especially during periods of time where the economy is up and down and people's sentiment is all over the place. And so I really like Class B multifamily. That's what we're focused on that side of the business. And so I found that investors have now looked at our company to say, look, they're not a one-stop shop. They have the opportunity to bring different types of asset classes that maybe I don't have exposure to. And the reason I'm doing these other asset classes, at least in the retail, industrial, and multifamily, is because us as business partners have experience brokering, redeveloping, and leasing those shopping centers out. I mean, we've signed in the last 10 years over 3,000 leases internally here at FTW Investments. And that's just experience that is invaluable to investors to absolutely understand how these things are structured.
It's interesting what you said about Class B multifamily, because I think that this is like an evolution that a lot of sponsors go through, right? You start out when you're first learning the business and you're looking at a pro forma and you're like, wow, Class C cash flows really well. And if I value add it, man, it's really going to cash flow even more. And they get very excited about it. And then and I certainly went through this, then what you realize is, well, yeah, on paper, it looks great. But when you have, I used to call myself a member of the water main break of the month club. And it was just, every time we started getting some momentum and getting some cash flow, then I'd be getting a call from a manager saying, Jonathan, I got another water main break. And then there's another $10,000 out the door to fix it. And it doesn't help you increase the rents at all. You realize after a while that, the Class B, you're going to wind up at the end of the day with the same return on that Class B without the headache, without having to do the value add. And I've had numerous conversations with other sponsors who have all kind of gone through the same evolution. And if they're a little further along in the game, they're even moving up into Class A and saying the heck with any of the rest of it. Just I'm going to buy something that was built 2 years ago.
Absolutely.
And has all the kinks worked out of it after construction, but it's it's at the very beginning of its useful life. And I think there's a lot to be said for that strategy.
I couldn't agree more. And I think that construction has evolved. And, when you think about stuff that was built in the 60s and 70s, there are useful lives of these sewers and these HVACs and these roofs and the foundations that are very difficult to plan for, even if you have the best of the best property and condition assessments and you have reserves and all of these things. But I'll tell you, like you mentioned, it's always something else. It's always something else. You get 2 steps forward and you take 3 steps back on these deals. Not to mention the opportunity of the buyer pool when you go to dispose of the asset. They're not getting younger, the age of the assets. So if you bought in the 70s, you hold for 5 years. Well, they're 5 years older now. And so I think that Class B is positioned really well, that and Class A in a lot of places, that you don't have to necessarily worry about that. But then also there's a lot of capital on the sidelines that is looking for multifamily. So if you can buy right, your disposition is going to be a lot easier. And let's be frank, when a lot of these deals, whenever you look at an IRR for an opportunity, most of the benefit is coming when a capital event is happening. These assets aren't being sold at 10 caps anymore. And so I think that's something to be important, that investors need to be thinking about, and something I've learned firsthand and has really shaped our thesis going forward.
Yeah, I think on the C, you mentioned too, another thing about the C assets is just sort of who your tenant base is and how resilient they are, right? And so that was the other issue that we always had with Class C, was just collecting the rent, right? You get rent increases, but you weren't collecting the rents, and that is an additional risk. And I think, if you're buying Class C deals, like you said, at 10 caps, you're building in a lot of margin of safety, and it can make sense in that situation. But when you're buying Class C deals at 5 caps, like we've seen in the last few years, you're basically just making a bet that in 2 or 3 years, the market's still going to be where it is. So you can, exit, you've raised your NOI a little bit and you can exit, at again, a really low cap rate. But I think those days, I don't know where we are, where we're going, but I don't think that those days are going to continue with higher interest rates. So we may be back in that situation where C deals are trading at 10 caps, and that'll be great. But for folks who bought them at 5s, I mean, there's going to be a lot of pain, I think.
Yeah. So, I mean, for example, we bought 1,000 Class B- C+ assets while the Green Street Property Price Index was just falling. I mean, the index went from 135 in 2020, early March, to all the way down and troughed out at 122. And that's when we were purchasing. So anywhere from $47,000 to $55,000 a unit with in-place rents of around $750. So those deals can make sense. Again, still a lot of CapEx issues and operational challenges. But like you mentioned, when those are sold, or when you buy them at $75,000 or $85,000 or $95,000 a unit, why not just go buy a Class B core asset that's newer with a better tenant population? I think that's a no-brainer and something that a lot of people have been making the shift towards.
And I do want to leave some time to talk about the Midwest, because I did at the top of the show promise that that's what we were going to talk about, and we haven't even gotten to it yet. So 35 minutes in, but yeah, I mean, so listen, you're obviously you're based in Kansas City, so you're looking at what's around you. But for folks who were, one of the things that and I'm sure this, everybody knows this. I mean, real estate is there's a lot of herd mentality in real estate, right? And a lot of people just are running towards certain markets because everybody else is running towards those markets. And for me personally, that's always just made me really anxious. Like when I see everybody doing the same thing, it just makes me want to do something else, right? And so for me, it's an obvious, thing. If you tell me, hey, Jonathan, this is what the demographics look like, this is what we're seeing coming in jobs wise, this is what the future looks like for these areas, this is what, infrastructure is coming in, I'm going to say, all right, I'm all in. But I think a lot of people are like, but it's not Texas. So I want to hear from you. Your boots on the ground, you're doing this every single day. Why is it that you think the Midwest is a good place to invest, and you're all in on it?
Well, I mean, I think everybody has been talking about affordability, and I think the rule of thumb is typically price to rent ratios around 30% of take-home pay. And so where can you find that? And that's obviously not going to reign true in certain markets, and I understand that. But when you think about, issues of either the Fed wanting to increase unemployment to try to bring down inflation based off the Phillips curve model that was debunked in the 70s. So I don't know why we're still continuing to do that. But at the end of the day, if that's their MO, then if people are out of work, how are they going to pay for their rent? That's one question that I always kind of try to understand. And so when you think about the Midwest, we typically are somewhere around 21 to 22% of people's take-home pay for Class B assets. Now, Class A, might trade up just a little bit higher than that, but those individuals are typically making 6 figures or close to it. And so that's a little bit of a different ballgame. But I love the affordability matrix. And so when you think about that, and then you pair that alongside, I think, a growing trend of being able to live where you don't work, it gives the ability for people to move to maybe some more affordable markets and still work at tech companies in California. That is a big trend that I think that a lot of markets have started to really see. Now, I'm not saying that Kansas City or anywhere in the Midwest is necessarily attracting the same talent as, maybe Austin, Texas, or something like that. But the affordability is probably a third or maybe close to a half of what it would be in Austin, Texas. And, I think people have some, issues with how cold and how hot it might get here in the Midwest. And I get that. But if you can get over the different seasons, it's really a nice place to live in certain areas, and for a really affordable place to live. And I think that's a main driver. Then you think about, okay, what are the other demand drivers? Well, you look at jobs and what moves in the Midwest. Well, we've started to kind of adopt a lot of technology, I think, which is great, but manufacturing, agriculture, transportation and logistics, and medical and medical jobs is what really moves the Midwest. And there's, for example, from the pipeline from Kansas City to Wichita, there's more veterinarian schools and clinics in that pipeline from Kansas City to Wichita than anywhere else in the United States. So maybe that's something you key in on. Or there's farms everywhere, and so there's maybe agriculture is something you take a look at. But we started to see, companies like Panasonic put down roots in the Midwest. So they're building a $4 billion, 4,000 job, manufacturing plant for batteries for Tesla, just 12 miles outside of Kansas City. You're starting to see that type of stuff. Then you really look at, well, who are the big employers? Well, you've got Garmin in Olathe as well. You've got Cerner, which was just bought by Oracle here in Kansas City. You've got a lot of good, stable jobs. And so I think the Kansas City's always had that kind of stable, steady Eddie market, which I think is good. But what's more exciting is when investors come in and they're like, man, maybe they come in from Denver. They're like, this really feels like maybe Denver did 10 years ago, or another bigger market did 10 years ago. So what I like to key in on is, where are the markets in the Midwest that are poised for real growth? And if you think about the Midwest, you have St. Louis, which I would say is on the other trajectory. You have Chicago, which is always going to be a mecca of the Midwest, but it's really cold, and that keeps a lot of people away from Chicago. Then you have Des Moines, you have Omaha and Lincoln, you have Kansas City in that, and you have Oklahoma City. I don't know if I missed any of the bigger ones, but those are typically the markets people are kind of looking at. Well, let's go down to Oklahoma. What drives Oklahoma? Well, that's the oil and gas industry, and commodities have proven to be very volatile over the years. And so when you look at the real estate that's being developed in Oklahoma, let's just take office, for example. I think 85 to 90% of the office usage in Oklahoma is based off of commodities and companies that are in the oil and gas industry. Well, what happens if that goes, bust, like it did a couple years ago when people were paying people to take their oil off their hands? Well, lots of jobs get cut, so just thinking about what drives those economies, I think, is really important. But then you think about Kansas City and what is really happening here. And I get to see this firsthand. Its focus is on the infrastructure. So you've got the new airport, you've got a streetcar that is connecting the city, you have development of classically, unoverlooked areas that have been dilapidated for many, many years. And it took a New York City firm to come into Kansas City and say, we're going to develop 200 acres down here and make this a new connection. On top of that, the city recognized that and said, we got to get a new bridge that connects the West Bottoms to our urban core. So you see that. You hear talk about the Royal Stadium coming downtown. You see the Crossroads Arts District that is just blowing up with new development. So when I see Millhouse and I see Mac and I see all of these Lux development coming into Kansas City and putting up big roots on deals, that is really a testament to, I think, a lot of analysis that has happened for Kansas City, and it's going to continue to drive population growth, job growth, and the ability for people that really see that opportunity now and see the infrastructure work that's going in to say, what can it be in 5 to 10 years? So being able to see the steady Eddie and be a part of that, but also that it might be poised for some serious growth, gets me really excited on understanding the demand drivers that could impact the city, and then trying to understand, okay, well, what real estate do you want to own because of that is a whole nother ballgame. But I do think that Kansas City is positioned really well. Des Moines is kind of like it's not the redheaded stepchild, but it is a little bit behind. There's a lot of finance going on in Des Moines, a lot of agriculture. And then Lincoln and Omaha also have the opportunity to kind of pop up. Don't know if they'll ever be as big as Kansas City, and that's okay, but they have a lot of the same demand drivers that allow me to go into those markets and say, okay, you guys might be a little bit behind Kansas City. That's fine. But what does the tenant population look like? What are the demand drivers for these other markets? And see that they're also poised for some growth, whether that be as much as Kansas City or not is a different story. But I do think that the affordability is really, and being able to always know that there's probably a job for you somewhere here in the Midwest has been a great a place for people to invest and to invest for cash flow, which I always like to prioritize in our real estate deals.
Yeah, when I first got started in this business, before this incredible run up that we've had, where you just saw cap rates compress between classes, between markets, like across the whole country, it used to be sort of like the standard thinking was, well, you've got like your big six markets, those are appreciation markets. You're just not going to get much cash flow You just hold for a long time and you just ride it up. And then you've got the Midwest, where you're not going to get a lot of appreciation, but you're going to get cash flow and you can buy really good cap rates, right? And that's the play in the Midwest. And then the South was seen as being a little bit of a mixture of the two because it had strong
Right.
population growth, but the prices hadn't been driven up so far at that point that it became a pure appreciation market. Now, as we're getting into this period of kind of like decompression and maybe hopefully returning to something that looks like normal again, do you see the Midwest kind of returning to that model as being like a good place if you want current cash flow to go and invest?
It's a little bit of a dichotomy because as Kansas City and the submarkets, primarily Johnson County, have really kind of put themselves on the map of best places to live. I mean, Olathe was number 3 on a list of 25 cities across the country, the best place to live. And it's like Olathe, now I own real estate in Olathe, so I'm like, heck yeah, that's great. But like, that's really interesting. And so why is that? Well, they took into account affordability, the jobs that are available, and the school districts. I think that's really important to think about because people want to live where their kids can go to good schools. And I think that so many folks just kind of gloss over that and maybe miss that, but it is so true. And when people pick on a place to live, an apartment to live. And so I think that that's a really interesting point to make in Kansas City is if you can go find a good job, have an affordable place to live, but also have good schools, that's going to attract people. And so that one part is been attracting more capital from outside into Kansas City. So I've started to see larger firms that looked at Kansas City kind of as a tertiary market and said, man, we're going to start putting roots down here. And so unfortunately for us on the multifamily side, at least, that started to drive prices way down. Now that people are like, interest rates are up, we've seen a kind of an exodus of like, hey, I'm going to go focus on my core markets. And, we bought some stuff in Kansas City and that's fine. Where I think the opportunity is as things, like you said, get back to more of a normal or a stable kind of position, people might look back to Kansas City and say, well, I can't find yield in the Sun Belt. I can't find yield in Arizona or Texas anymore. So Kansas City is going to get back to that kind of that market that people are like, ooh, I want to go grab some cash flow. And then they're going to dive in and say, oh my gosh, new airport, streetcar, all the new development. This could be a mixture of both, similar to the Sun Belt was. So I think that, I wonder how long that takes, honestly, and how that's going to impact the real estate market as a whole here in Kansas City. But my guidance to investors has been, well, let's go buy deals right now. So if that cash flow, and if and when we do hit a period of time where capital flows back into Kansas City, because those players have already looked at the market, and when they deem the time is right, they will then go pay for assets at a lower cap rate. So I think that it's a really great spot to be in. Just knowing that you can cash flow if you buy right, but also the ability to maybe have a little bit more appreciation. I mean, there was stuff trading in Kansas City I just saw. It was a new development deal, so take that into consideration, Class A, but under a 4 cap, and that's in Kansas City, Missouri. I mean, that's pretty wild to think about. So I don't know if we get back to 4 caps anytime soon in Kansas City, but if you could buy at a 7 or an 8 cap, and you can hold in cash flow and then sell at a 5, I mean, that's a pretty good deal. So I think that, having the ability to talk about the appreciation and being also able to cash flow is extremely important and something that prudent investors should be thinking about, and we think about a lot.
So we're kind of running out of time, but I did have a couple last questions. So one is, do you raise money from your old NFL buddies? Do you have investors from the NFL? You focus on
not necessarily anybody that I actually played with. When I was out there, I was at Oakland, the Raiders camp. But having that affiliation has opened doors to the Kansas City NFLPA here. There's a lot of players that have played for the Chiefs and or played and then moved back to Kansas City. So being able to network with those guys is phenomenal. And just being able to tell that story, I think, is a great way that attracts people into the story of, hey, what was the trajectory in and out of, from how did you get into real estate? And so that opens a lot of doors because many of us were competitive and athletes at one point. And so it's just, if anything, it's probably created more of a common bond that we can talk about. I don't necessarily go focus on NFL guys. What I found with professional athletes is they usually have a posse around them, and you've got to get into that posse. And if you're taking taking capital away from that posse and they're not getting paid for it, it's a really hard network to kind of break into. So different story for a different day there, but it definitely helps open doors and have good conversations with people.
And then the last question is, where do you see yourself in, say, 10 years?
What I've tried to kind of the vision casting, at least what I've thought about a lot is how do you build a company that can be a true full service real estate advisory firm that attracts capital that maybe wants just to allocate to Kansas City at some point. So thinking about how I can create an advantage on the operational side and be able to really attract that capital in different, and this is my goal, in different fund structures, because I've started to have a decent amount of conversations with registered investment advisors. And there are some that are open to alternatives. There's some that are not, that's fine. But the way that their clients and the way that they view investments is through income, growth, and income plus. So a little bit of both. So being able to create products that I can then showcase to other people that don't live and talk the same way that I do in regards to real estate, so they can understand it in a really cohesive manner, is kind of where our goal is to be able to attract different types of sources of capital into the business. I would love to really understand the development game at some point. It gets me excited. I love feasibility. I love thinking about different areas and being able to really transform certain areas. I also understand the risks and the capital that takes to do that well. And so I would say that we would be much more involved in new development, especially as Kansas City is poised to grow, because if you can do the right types of development deals, there'll be capital that's looking to acquire that because of the risk that you took. So I would like to get into that for sure at some point as well. And then just really being a great leader, I would say is kind of my next part. Is I've always been, well, not always now, but previous in my career, I was a producer. And so when you move from player to coach, there's a whole nother level of skill sets and leadership that you have to embody. And so I've been rereading a lot of Jocko Willink's books, Extreme Ownership, The Dichotomy of Leadership, Leadership Strategy and Tactics, and just really trying to dive in and understand how to make that effective so I can help younger individuals really grow through their careers. And that's been one really fun thing for me and a challenging thing for me. So I want to just become a really great leader as well.
Well, that's a great place to end this conversation. If people want to get in touch with you and learn more about what you're doing, or get on your investor list, or just have a conversation, what's the best way for them to reach out?
You can always find me on LinkedIn. I post every day basically, but Sunday. So that's Mr. Kansas City, Logan Freeman. My big mug will pop up there. But if you want to go to our website, it's ftwinvestmentsllc.com. That's ftwinvestmentsllc.com. Plenty of calls to action on the website. You'll get to talk to me. I'd love to chat with anybody that's interested in the Midwest.
You should absolutely follow Logan on LinkedIn. I started following him recently, and he just posts really great stuff pretty much every day. So I've really enjoyed your LinkedIn, and glad that we're connected now. So thanks very much for your time today, Logan. I really enjoyed this, and we'll be seeing you soon.
Yeah, thanks for having me on.